Hi, this is Jim Perry, August 6th, Wednesday, hump day, and a week after Mr. Powell did not cut rates. We have had a bout of forced selling in the marketplace that has been phenomenal and very frightening. I want to bring some enlightenment to that and talk a little bit about the economy. But the leverage carry trade, margin calls, and forced selling first. Carry trading is about borrowing money cheaply, in this case Japan, for the last 10 or 15 years especially, through your prime broker, who also has to put on a currency hedge. The cost of that hedge skyrocketed as the dollar started falling on July 3rd. The dollar is down 12.5% against the yen since that day. It is also down 5% against the Swiss franc. These are two other safe haven currencies. Nobody thought the dollar would go down against them. They always thought it was going to go down against the BRICS, right? The Brazil, China, India, Russia. They're down too. So the forced selling. If your cost of hedging goes up, you get a margin call because you don't have enough collateral in your account to keep the trade open. If you can't bring more money to the table, you have to liquidate the trade. That's what's happened. Is it over? It is, if volatility stays here. If volatility picks up in any portion of the hedge, you'll get more forced selling for sure. So volatility, how do you measure it? Well, in the stock market, it's the VIX. It went from 16, even after Powell was done speaking about not cutting rates last Wednesday. It went to 30 on Friday, and it went to 65 on Monday. That's an enormous move in the VIX, one of the biggest ones I've seen in my career. The MOVE index, which measures volatility in the bond market, also went up. It went from 80 to 120 over the last week, and it's still at 120. So volatility in the bond market's up 50%, volatility in the stock market's up 100. The cost of those hedges are equally expensive. New risk taking isn't going to happen from this cohort in the market. And more risk will come off if volatility in any portion of that hedge rises. And it probably will, because this administration, if reelected, will do the same thing that the administration has done for the last 3 years, which is tax and spend. And everybody thought there would be no consequences, the modern monetary theorists, to national debt at $35 trillion and a budget deficit of $2 trillion annually, expected to go to $3 trillion in the next year or two, and a trade deficit, which is extremely expensive to keep going. So the triple deficits, the double deficits, and the national debt have to have consequences. And the consequences are the lower dollar. It's down 12.5%. The dollar has probably seen its high on a trade-weighted basis through the election, and certainly, and probably if they get reelected for longer. And that's a problem for the stock market and the bond market. So be very careful. I don't think risk exposure is going to go up between now and the election, and there's a good chance it goes down and we get another bout of forced selling. So be careful, because households and businesses are not in a good mood. Half the country thinks we're in a recession already, and they think that the Fed should have cut last week. Well, the Atlanta Fed says GDP is going to be 2.9% in the third quarter. That's not a recession, but it sure feels like it to households, right? Household income is not keeping up with household expenses. So disposable income is falling. It's under significant pressure. 78% of people polled said that going out for fast food's a luxury. That's a sentiment shift. That's a problem. So I think the market's on very, very shaky ground right now. I don't think you need to take a whole lot of risk. And I think that if volatility goes up, you'll get some more forced selling. So be careful. Thank you. Bye.